Hello, OG family. This morning something happened in London that most retail traders will never even see on their screens. 1-month silver lease rates jumped to 6.3%. That number might sound technical, maybe even boring at first glance, but it's not. It's the cost to borrow real physical silver sitting inside London vaults. And rates do not jump like that when metal is easy to find. Before we go deeper, let me say this clearly. If you want updates that focus on what's happening in the physical market, not just futures charts and social media noise, make sure you subscribe right now. If staying ahead of real institutional signals matters to you, hit that subscribe button and stay connected. Most people only watch price. We watch structure. We watch stress. We watch the plumbing of the system. Now here's the paradox. While lease rates in London are surging to 6.3%, COMEX futures printed $72.62 yesterday, and paper silver is hovering between $72 and $75. Paper pricing suggests comfort. Lease rates suggest strain. Two realities are coexisting, but they cannot coexist forever. And in just 9 days on February 27th, first notice day for the March contract, we may find out which version of reality is closer to the truth. On top of that, in just a few hours, the FOMC minutes are scheduled for release. Depending on tone, they could accelerate pressure in either direction. But here's the key. The 6.3% lease rate spike happened before the Fed minutes. It is already happening. And if this kind of detailed, on-the-ground breakdown of the physical silver market is valuable to you, subscribe again if you haven't already. Roughly 3/4 of viewers don't. If you want to understand the difference between paper price movement and physical metal availability, this is exactly what we track here. Now let's slow this down and explain what lease rates actually mean. A silver lease rate is the annualized interest rate charged to borrow physical silver. Think of it like paying interest to borrow money, except instead of cash, you're borrowing bars of silver from a vault. Who needs to borrow silver? Short sellers who must deliver against contracts, industrial users who have forward commitments, arbitrage traders moving metal between markets, banks hedging over-the-counter derivative exposure. All of them at certain times require actual metal. Not futures contracts, not ETFs, not IOUs, physical bars. When lease rates are low, say 1% to 2%, that tells you there's ample lendable inventory in vaults. Supply comfortably meets borrowing demand. The system is liquid. When lease rates spike above 6%, that signals stress. It means demand to borrow physical silver exceeds what vault holders are willing to lend cheaply. Lenders are saying, if you want my metal, you're going to pay for it. And today, someone in London is willing to pay 6.3% annualized just to access silver for 1 month. That's not normal during a period when futures markets are implying abundance. Now let's add historical context. Back in October 2025, during the last major physical dislocation, lease rates briefly surged into double digits. That was when large quantities of silver were being moved across jurisdictions amid tariff concerns and delivery pressure. The spike reflected urgency. Metal needed to be sourced immediately. After that episode cooled down, lease rates did retreat, but they never returned to the ultra-low levels seen before the squeeze attempt. The baseline shifted higher, the structure changed. And now, with COMEX registered inventory around 102 million ounces and March open interest representing roughly 366 million ounces of notional exposure, we're seeing lease rates spike again, 9 days before first notice. That timing matters. Now let's connect this to backwardation, because lease rates alone don't tell the full story. Backwardation occurs when spot silver trades above futures contracts. In a healthy, well-supplied commodity market, futures typically trade at a premium to spot. That premium reflects storage, insurance, and financing costs over time, a condition known as contango. But when spot trades above futures, the curve inverts. That inversion says something very specific. The market is willing to pay more for immediate delivery than for delivery in the future. It's a signal that the need for metal now outweighs the cost of waiting. Recently, London spot pricing has been trading above certain COMEX futures contracts. That's not just a chart anomaly, it's a structural signal. Lease rates at 6.3% plus backwardation equals tightening conditions in physical markets. Meanwhile, the futures screen still shows $72 to $75. Let's add another layer, inventory. COMEX registered silver sits near 102 million ounces. That number has fallen significantly from prior peaks. Open interest on paper represents multiples of that amount. Now, not all contracts stand for delivery. Most are rolled or closed. But leverage ratios matter when stress builds. And here's the important point. Lease rates spike because physical metal is required somewhere in the system. Now let's talk about who might be borrowing at 6.3%. One possibility is short sellers who need to fulfill delivery obligations. Instead of buying outright at spot, they may choose to borrow silver temporarily, hoping prices ease before they have to return it. Another possibility is industrial users. Silver is a critical component in solar panels, electronics, medical devices, and various industrial applications. If a manufacturer has forward sold output but hasn't secured raw material, borrowing becomes necessary to keep production flowing. Then you have arbitrage participants. If pricing discrepancies exist between London and New York, traders may borrow metal, move it across markets, and capture spreads, but only if the economics justify the borrowing cost. Finally, banks and market makers managing derivative books may need to source physical exposure to hedge risk. All of these scenarios require real metal, not digital contracts. And at 6.3%, that metal isn't cheap to access. Now let's talk about what happens when lease rates rise. Higher borrowing costs increase the expense of maintaining short positions. That can discourage speculative shorting. If shorts reduce exposure or cover positions, buying pressure increases. If buying pressure lifts prices, more shorts feel pressure. It becomes reflexive. We saw elements of that dynamic in prior episodes. But here's the nuance. A lease rate spike alone does not guarantee a price surge. It signals tightness, not inevitability. Now add the macro layer. In a few hours, the Federal Reserve releases minutes from its prior meeting. Markets will parse language for hints of dovish or hawkish bias. Dovish tone could weaken the dollar and support precious metals. Hawkish tone could apply short-term pressure. But again, lease rates moved before the minutes. The physical market is sending its own signal independent of central bank commentary, and we're 9 days away from first notice day. Between now and February 27th, positioning decisions must be made. Longs will decide whether to roll or stand for delivery. Shorts will determine whether to cover or deliver. Inventory data will be watched closely. If delivery demand increases while registered inventory remains constrained, stress could intensify. If contracts roll forward smoothly, immediate pressure may ease. No one knows the exact outcome, but here are the confirmed facts. Lease rates reached 6.3% this morning. Spot pricing has shown backwardation signals. Registered inventory is near 102 million ounces. Open interest remains multiple times higher. A major streaming company recently committed billions to secure long-term supply. Those are structural indicators, not predictions. Now, let's address risk. Lease rates can retreat. Backwardation can reverse. If macro conditions shift, industrial demand slows, or delivery pressure fades, tightness can ease. This is not a guaranteed squeeze narrative. It is a structural observation. When lease rates spike and backwardation persists, the market is under tension. Sometimes that tension resolves quietly, sometimes it resolves violently. The next 9 days matter, but what matters more is understanding the difference between futures price action and physical availability. Futures can move quickly on sentiment, liquidity, and macro headlines. Physical stress builds more slowly, and often more quietly. Today's 6.3% lease rate is not hype. It's not social media speculation. It's a documented borrowing cost in the London bullion market. That doesn't guarantee what happens next week. It tells you something about current conditions. And eventually, markets reconcile divergences. Either paper pricing aligns with physical tightness, or physical tightness eases to match paper pricing. History shows that when borrowing costs rise and spot premiums persist, adjustments often come through price rather than abundance. But timing is always uncertain. So here's the takeaway. Don't trade headlines blindly. Don't ignore structural signals. Don't assume future screens tell the entire story. Watch lease rates. Watch inventory. Watch delivery data. We are 9 days from a key delivery window. Lease rates are elevated. Backwardation is present. The Fed minutes are hours away. Multiple variables are converging. But whatever happens next week, the lesson remains the same. Understand the plumbing beneath the price. If you found value in this deep dive into the physical silver market, stay connected. We'll continue tracking real signals, not just speculation. Use your own judgment. Assess risk carefully. Invest with discipline, not emotion. Physical markets speak quietly until they don't. OG out.